So, welcome to Bruegel. I'm Jeremy Zettelmeier. I'm the director of Bruegel, and today I'm absolutely delighted to have with us Andrew Bailey, the governor of the Bank of England. Before I actually took over Bruegel, I visited in March of 2022, and Andrew Bailey was here doing a fireside chat with my predecessor, Guntram Wolf. So, for me, you are sort of forever tied to my Bruegel initiation. So, Governor Bailey has been governor of the Bank of England since 2020. He succeeded Mark Carney, following a long and distinguished career at the bank. He entered in 1985, 40 years ago, with a PhD in economic history from Cambridge. And he's had many roles, including as head of the Bank of England's International Analysis Division, chief cashier for about 7 years, I believe, 2004 to 2011, deputy governor for prudential regulation, and then chief executive of the Financial Conduct Authority, the FCA, from 2016 to 2020, after which he became the governor. So what we have agreed is, as always with our fireside chats, and by the way, this is the fourth that I'm leaving. There were three all four with, at least with former central bankers. So I had one with Olli Rehn, one with Pierre Wunsch, one with Mario Draghi last October, and now with you. It's about taking a slightly broader view of things than what is immediately on our minds today, even though we will come to that. So I wanted to start a little bit with the past and just invite you to take stock. You could not have chosen a worse period to be the governor. I mean, Governor Bailey literally came in on March 16th, 2020, which is one day after we were sent home at the IMF. I was at the IMF at the time. So there was complete lockdown, and then, the crisis really started, and we were on Zoom all the time. And so it must have been similar to you. Then when I met you at Bruegel, this was March 2022, it was like two weeks after the invasion of Ukraine, with energy prices were already going through the roof. I remember your talk was essentially about the trade-offs that involved, essentially the supply shock dilemma. On the one hand, you get purchasing power parity being squeezed, demand gets squeezed. On the other hand, you have the price level effect. What do you do? And our first instinct is to accommodate. And that's what we initially tried, and the question is, was this right? And, things have not gotten necessarily easier from then. You had the mini-budget crisis with a genuine non-bank financial sector crisis of the famous LDIs, liability-driven investment instruments. But now, things are coming down, right? So they are normalizing. And so please, take stock a little bit. Do you feel you are through a cycle and we can declare victory at some level at this point?
It should be. Just yeah. Hopefully. Oh, yeah, that sounds good. Yeah, thank you. Well, first of all, can I say thank you for having me back and welcoming me back to Bruegel. It's a great pleasure to be here and to be in Brussels today again. I mean, you're right. I have terrible timing. I mean, you're absolutely right. As you say, I started right at the start. Actually, the lockdown in the UK was the end of week one. But before we even got to the end of week one, we'd had a sort of meltdown in financial markets, which is now sort of popularly known as the dash for cash. We'd had to do an emergency monetary policy committee meeting on day 3. I think we concluded on day 4. We did our biggest ever intervention in terms of asset purchases on day 5. That was the Friday, and I think UK went into national lockdown, if I remember, on the next Monday. So, yeah, things got off to a good start. And as you say, we've had a few things have happened since. So the question of, well, where are we today? Well, I think today we're in a period of, frankly, heightened uncertainty, I think. And we all know what's going on, obviously, around us. The situation, we published a monetary policy report just around 2 weeks ago with a new projection. And the challenge we faced was that we think that the underlying trend of disinflation post the events that you were talking about 2-3 years ago has actually gone progressively. It is continuing, and in actual fact, when you look back at history, that disinflation, it's obviously, frankly, more than uncomfortable to have inflation where it was. The process of disinflation has actually gone faster than actually we thought it would, based on a lot of history. And I think that is, first of all, a very positive thing I take from that. I think that is actually reinforcing the role that the regimes we have in place today and the nominal anchors we have in place today as a result of those regimes, the role they play. So that's helpful, good. And it was that allowed us to decide that the important thing we should do now is do a further cut, the third cut in rates, because we are facing a weak growth environment in the UK. But the challenge we had was twofold, really. Threefold actually. One, it's quite hard in the UK to work out to what extent that weaker growth story in the immediate context is a result of supply side weakness or supply and demand side weakness. In the classic monetary policy body way, we ended up concluding there was some of both in there, but also that, frankly, we will learn a lot more about that as time goes on. The second thing is that we are facing a short-run hump in inflation. It's going to go up, but nothing like what it was a few years ago. But nearly all of that short-run hump comes from administered prices, so particularly in the energy market, water, some other public services. And so again, we took two views on that. One was, well, this is not telling us a story about the sort of fundamental state of the economy. Secondly, it's going to take place against a background of a position which is sort of weaker in growth terms than we thought it would be. So that again, we had to take the view, do we look through? And we have. The third one, of course, then, is we may come on to, is of course the general state of uncertainty in the world around us and the events that are going on around us. And we think there are now sort of what I call two-sided risks here. It could go, frankly, either way. I mean, obviously the hump and inflation could create some second-round effects. We don't think that's not our best assumption, but we think it could. The supply-demand imbalance of weaker growth could turn out to be more demand, which would tend to obviously have an effect of reducing inflation, but we don't know that. So it could also turn out to be more supply, of course, which would have the other effect. And then we've got the general background, of course, of developments in the world economy, the tariff question, obviously the effects that the uncertainties around the events around Ukraine and so on are having as well. But we concluded that the risks were on sort of two sides. We then, as is classic for monetary policy bodies, spent a lot of time debating the language we should use. We've been using the word gradual for quite a while, some time now. That really defines the sort of this process of disinflation. It is gradual. Then we debated whether to use and this comes out in the minutes, whether to use the word careful or the word cautious. I mean, you might say, this is the stuff of central banking. It really is. This is where you get down to the really important. But it is important because, in a way, I mean, the debate was this. Cautious, which is actually more in the central bank lexicon, actually, probably has a bit more of a directional sort of tone to it. Careful, we thought, which actually isn't so much, interestingly, in the central bank lexicon, I think has a bit more of a two-sided feel to it. Yeah, you might say, well, you're always going to be careful. Hopefully you're not going to be careless. But it was done deliberately to say, look, there is more uncertainty.
Thank you, Governor. Before we are going to get to, in a way, the current juncture and the risks in some detail. But before we go there, I just wanted to ask you, apart from managing this incredibly difficult sequence of crises, and in the end coming out well, have the last 5 years changed something about the institution, about your frameworks, about the way you analyze the real economy? So have there been, when an institution is jerked around like that, has to react, it's a big test, right, of internal mechanisms and methods. And how, if any, if at all, have these methods, mechanisms, frameworks changed as a result of the crisis?
No, great question. Well, let me start my broader answer is yes, and substantively yes, but let me just reinforce a point that I've just made, which is sort of goes on the other side of that point, which is it hasn't, in fact, it's reinforced, I think, my and our commitment to the regime, the target, and the nominal anchor, because I think it has actually, in a sense, demonstrated its real worth. I said quite early on in this process, I may have said it last time I was here, actually, I think this is going to be this is the first big test, in a way, of inflation targeting, certainly for us. I mean, we had obviously quite a, I think Mervyn King called it the nice period initially up to the financial crisis. Financial crisis was difficult, and inflation did go up, but nothing like obviously what we saw in the 21, 22, 23 period. So this has been the first big test of it, and I think it's come through that test well, particularly in terms, as I said, of looking at sort of inflation persistence and second round effects. So for me, it's reinforced why we have these frameworks and why we must be absolutely committed to them. Now, great question on what follows. What about the rest? What about what you actually do? Yeah, we have looked hard at it, and that's why I was very clear and was very pleased when Ben Bernanke agreed to do the review for us of our processes. I mean, it's interesting. So one of the things that gets less reported in Ben Bernanke's report is that he did a forecast comparison. He said to me, I'll do a forecast comparison. And he said, look, I've done a forecast comparison and you're sort of in the pack. And he said, and I'm not terribly surprised, because he said, look, the issue is common. The basic models and processes are not designed to deal with big external supply shocks. Unexpected big external supply shocks. So everybody's in the same boat, whether you're a central bank forecaster, the IMF, whether you're in the commercial forecaster, you're all in the same boat in that sense. But the question is, what can we learn from it? And that's the really important thing. And I think Ben's report is terrific in that sense. Now, what he didn't say was, well, if only you use the following model, your problems would go away, because clearly, I'm afraid that's a nirvana that doesn't exist. I mean, it's sort of like searching for the Holy Grail. You're not going to find it. But he gave us a lot of very good advice on things about modernizing our infrastructure, how we use models, and also just how the committee itself works. And we've got a big program of work at the moment, which Claire Lombardelli, our Deputy Governor, is leading, to put that into effect. And I think we're already beginning to see real benefits from that. What I would say, though, is it does get to some of the really sort of almost the critical questions that all central banks face, such as how many models do you use? How do you sort of use them? Do you have a core model and then supplementary models? How do you use them? Do you use scenarios? Ben Bernanke sort of suggested to us, I think it would be good to use scenarios, and we've taken a sort of first step in that direction. We're doing a lot more work as to where we want to end up on that. Then I think a very big question that sits for all central banks: do you condition your view of the future by you as a central bank decision-making body taking a view on the interest rate curve going forwards, or do you effectively borrow the market curve? We do the latter. We've been very sort of, frankly, sort of cautious about wanting to take our own view, because it's not because we may not have a view, but it's because it then becomes absolutely sort of embedded in ways that probably, has a certainty that we don't want to attribute to it. But if you use the market curve, how do you then sort of, in a sense, interpret it? How do you comment on it? What do you make of it at times? Do you always agree with it? And we're still working our way through that issue. So he's given us some very good challenges. So out of that, I'm very pleased. I think it's not going to suddenly solve all known problems in economic modelling and forecasting, but I think it's given us a very rich set of issues. And my fellow central bankers sometimes say, I'm really pleased you had that report because we've learned a lot from it. No, that's great.
Great. So one of the things you're known for, I think, more than other reserve currency central bankers, is your engagement with non-bank financial sector risks, right? And some of this obviously is out of necessity, since you actually had to manage some of those risks directly. So you gave a very nice speech last week on this in London. I'm going to quote a little bit from that speech and then ask you to comment and expand. So that you say that although as at least I interpreted, the global financial crisis was largely a crisis originating in the non-bank financial system, now I quote, "What came out of the GFC and post-GFC policies was a further shift in the balance of financial intermediation from the banking to the non-banking system, with the non-bank sector now making up nearly 50% of global financial assets compared to 40% for the banking sector." And then you go on to discuss some changes in the structure of the financial system, to name some examples: multi-manager hedge funds with some centralized risk management that, because this makes them safer to some extent, they can also benefit from higher leverage from banks. Trade based on statistical models and market signals rather than fundamentals. And increasing risk assumed by non-bank market makers that, and I quote again, "while not inherently bad, it could create a new set of financial stability vulnerabilities." So can you maybe comment a little bit on how you see this as affecting risks in the non-bank financial sector and what supervisors and regulators should do about it? And the thing I'm particularly interested in is whether this, what does this do for traditional views of financial supervision and regulation? Does it in some sense invalidate our focus on bank regulation, or does it in a way reinforce it, because banks of course are exposed to the non-bank financial sector, and how should we see the Basel process, for example, in that context?
Yeah, thanks, Dave. Well, thanks for your kind remarks about the speech. Just to give a bit of a flavour of what lay behind it, and I'll take your question on as well. I think, as you say, we saw coming out of the financial crisis a shift in the balance of bank and non-bank intermediation. And I've said for a long time, we shouldn't be surprised at that. In a way, that's what we designed, because I think one of the things we saw in the financial crisis was, some types of asset and some types of activity in the banking sector which didn't seem to particularly well fit with the basic liability of the banking sector, which is a deposit. So in a sense, the regulation that we put in place post-financial crisis was, in an underlying sense, had that outcome built into it almost. So we shouldn't be surprised at that. But what I drew out in the speech was a point that, a lot of our market intelligence teams have been saying to me for a little while, which is, yeah, that's the starting point. But actually in the last 5 years or so, roughly, we have seen a big acceleration and a big shift in the nature and form of financial intermediation. So actually it's not just the post-financial crisis change. Things have actually changed rapidly in the last 5 years, say, and the pace of change isn't slowing down. So it's then building on that. We've seen a lot more change. And to give an example, which I drew on in the speech, certainly, the scale of activity and position taking in government bond markets, for instance, and not just the big ones. I talked to some of the central banks got sort of medium-sized government bond markets, and they say exactly the same thing, that the scale of position taking and leverage in government bond markets has changed very substantially. And this is essentially a non-bank phenomenon. Now, you rightly point to the really important issue then. So if you go back, I quoted a report I worked on in 1985-6 in my very, very early days, in a little bit, the BIS did. And in many ways, the established sort of wisdom in those days was that the non-bank sector wasn't systemic. And that was partly because of the nature of it, but partly also because in a way there was a view that, in a sense, the the banking system took care of, the sort of the systemic risk, if you like, including because central banks put liquidity into the banking system. And I think it certainly means something in the UK. I think it probably does it elsewhere in Europe. There's an old Heineken beer ad. It reaches the parts other beers can't reach. And I said it's like this with central bank liquidity.
I just want to say that in an age of economic nationalism, I was very impressed that you quoted a Dutch beer to make that point. Since the Brits are rightly proud of their own beers.
Quite a lot of Heineken is drunk in Britain, and Dutch beer generally. Thank you. But the reason I go back to that is because I think what we are now seeing is, and this is why the non-bank system is so much more important and has to be in our focus, and is that assumption that you can reach the non-bank system and deal with the systemic problems through the banking system and through liquidity in the banking system, I think has to be substantially questioned. And that is in part because of the relative balance of the size of intermediation, and partly because of just the nature of it. And we, as I described in a speech, we did an exercise last year which we call the system-wide exploratory scenario, which was designed to get at this really, and to do what I describe as much more of a flow-type stress test rather than a static sort of bank stress test. Because I think market tests have to be, and basically we got just over 50 market participants of various sorts to participate, and said to them, we're going to give you a stress scenario, and we want you to put it through your business and tell us how you would respond to it and what effect it would have, and then we will aggregate those responses. And we deliberately focused it on essentially the type of market stress that I was just talking about, putting stress into a government bond market trading scenario, for instance, because we were interested in core markets. And what we got out of it was, we did it in 2 rounds. We always do stress tests in 2 rounds, because in the first round you realise what you should have asked in the first place and didn't, and then you can come back in the second round and sort of slightly course correct. And we were testing 2 things which come together. One was, where would the points of stress be? Secondly, we wanted to know the assumptions that the participants made about how they would respond to the stress, and whether those were consistent with the market. If you add them all up, are they consistent? Because one of the things that I would observe in some of the non-bank crises we've seen is what I called inconsistent risk management assumptions. I think I gave the example in the speech. Archegos is a good one here. Each participant, in a sense, was making an assumption which could only be validated, really, if they could see the assumptions that others were making, and therefore the positions, but they didn't. And when you added the whole thing up, it looked inconsistent, and frankly, it ended in trouble. And we saw some of that, and I think those are the sorts of things that we need to develop. And I think we need to really develop our surveillance tools, not least to finish, because we are facing a world where there is more pushback on regulation, and I think we have to use some of these surveillance tools to say, we're going to lay out the facts and the sort of the situation as we see it, because it will give us more of an evidence base to then decide what we do.
Great. So I will ask you 1.5 more questions, and then we'll open it to the floor. So my next question is sort of, I think, what's on everyone's mind and what, in a sense, motivated the title of our event today on preserving and enhancing open financial markets. So we are back in an era of economic nationalism. There are systemic risks, I think, coming from the change in policies in the United States, and I can see at least 3. One is financial deregulation or laxer standards, both for banks and the non-bank financial sector, like crypto. And so here there's a question on whether you see pressure on the UK to follow the US in this regard. The UK often, in a very well-meaning way, views itself as a bridge between Europe and the United States. You can very crudely interpret this as being some sort of weighted average of the two, but then, what weight do you want to put on that regulatory approach, okay? The second issue that I'm concerned with, and here I struggle conceptually, is financial fragmentation. I mean, here we have, of course, fragmentation related to economic security, FDI, but other than, in a sanction scenario, we do not yet have it in financial markets more broadly. So the question I struggle with is it really possible to keep financial markets open at a time when goods markets internationally are closing? And then the third aspect is the possible erosion of the dollar's centrality in the global monetary order, which could be accelerated by some of the policies in the US now. And I have a feeling that as sort of the world's premier global financial center, this would affect the UK, but I'm not sure exactly how. So if you can sort of broadly comment on these risks and what UK authorities, particularly the bank, can do about them.
Oh, thank you. Well, that's a small agenda. Could be here all day on this one. Well, let me start, and it's obviously hugely important. Fragmentation is bad for global growth. And by the way, I mean economic and financial fragmentation. And I do think we have to make that point clear. Now, I do think that we have to work to say, let's get to the bottom of the issues that lead to this pressure for fragmentation. I do think we also, and I know you had a very distinguished career at the IMF. I think it's critically important that we preserve the multilateral framework, but that we address the issues through that. So, we've known for a very, very long time that obviously Bretton Woods was designed with an asymmetry in it. Of course, ironically, the asymmetry was the other way around, because the US was in the opposite position then to how it has been really since the 70s. By the way, I find it very interesting. Over Christmas, I reread one of the books on the 1971 end of the Bretton Woods dollar standard, if you like, and it's interesting to look at some of the parallels between the issues that the Nixon administration identified at that point and where we are today, including, by the way, defense expenditure. It's interestingly in the sharing of defense expenditure. Very interesting to see that. But I say that because I think we have to say, look, where we have these pressures within the world economy, where we have pressures caused by imbalances, we have to get to in a sense, we get to the bottom of the economics of what's causing those imbalances. If we've got imbalances between, domestic demand in some parts of the world and others, what's causing those? And I think, that's the way we have to tackle it. And that's why, the IMF has a crucial role to play in this respect. Because that's the way we can begin to get these issues on the table as people want to do. Fair enough, absolutely fair enough, by the way, without getting fragmentation. So I think we all have to be constructive in that, but make the point quite clearly. And then to the second part you raised, which is this question about innovation and where does that lead to? Just make a point. I made a point in a speech last week, and I make it sort of almost every time I talk now. I mean, there is pressure, obviously, for looking again at regulation, and that's reasonable because we've got in the UK a situation where we've had what I call low structural growth since the financial crisis. The financial crisis was a break in the sort of supply side growth rate in the UK, and we're not alone in this respect at all. And I think we do have to look at what underlies it. But there is no trade-off between financial stability and growth. I mean, that's the question I have to make. And we saw that in the financial crisis, and I think we do have to remember that. But it's quite reasonable then to say, well, there are all sorts, of course, of regulatory things you can do and have done, and we have to keep looking at, are they working efficiently and as they should do? So I'm a supporter of that. On the final point I make, on your very good point about US and Europe, and the role of the dollar. I mean, I do think it's important that we have a stable payment system. The dollar is, of course, an important part of that. I do think that the cross-border payment system frankly, is old in its sort of infrastructure. It's not very efficient in quite a few places. And we should be looking to get the benefits of digital technology, innovation, and so on to, frankly, modernize that. The question then is, again, is how can we best do that in a way that doesn't cause fragmentation? And I think we are going to have to have some very open conversations about that. I'm expecting that we will complete the renewal of our wholesale payments infrastructure this spring. That creates a huge opportunity for innovation in our system, but we're only part of it, obviously. And I'll end by saying, payments is very rightly occupying quite a lot of the agenda in the central bank world at the moment, and that's right. And of course, there are big innovations like stablecoin, for instance, and we do need to work hard, I think, as to how we see those innovations incorporated in a way that preserves financial stability.
Thank you, Governor. I will keep my half question in reserve, and we're going to turn to the audience. So you can ask questions in two ways. People in the room can just raise their hands, and then we have Slido, where the code word is #openmarkets. And I do have quite a few questions on Slido already. So while you are thinking what to ask, thank you, I got you. I will read out a few of the Slido questions. Now, as you're used to this game. They always try to get some information from you on the next move, right? So I'm just going to read out a few of those, and then you decide what to take and what to ignore. The conjunctural. So I'm bundling the conjunctural questions, right? So there's a question from a Bloomberg journalist saying this morning's jobs report suggests employment is not falling, as many feared after the budget. Is the labor market more resilient than you expected? Good morning. Do you feel markets have interpreted the signal that there will be no rate cut in March and May? There is a good chance with your new forecast. Not quite sure what that means. You probably know what that question means, but I don't. And finally, the question about guiding markets on a rate path, mortgage market forecast, transparency, and so forth. Just give us some, whatever you want to answer from that
Sure.
bundle.
Well, I've only had a brief look at the labour market report so far because I started early this morning, but I've had a brief look at it. To be honest, it looked to me on the quantity side to be not far out of line with what we were expecting. Pay growth went up, but actually not quite as much as we were expecting. I have to say, we've said many times, I just caution all of this. It is hard to read the employment data in the labour market data in the UK at the moment. We spend a lot of time on the pay issue in the last monetary policy report. You've seen what we published. We do think that it's going to come down during the next year. One of the best anchors we have is the survey that our agents around the country do every year, and they think settlements this year are going to come down. So I don't think we saw anything this morning that fundamentally changes that, but we'll spend obviously a lot of time when we get together in March as the Monetary Policy Committee going over that. On the question of what signal you should take, well, I think the signal you should take is exactly what I said earlier. Look, we've used the words gradual and careful. There are two-sided risks. We're not providing a steer on we're going to cut now, we're not going to cut then. We don't do that. That's not how we tend to, we typically signal policy. We do take it meeting by meeting. So we will, the one thing I can always predict with total certainty, there's another meeting. So we'll come back in March. Just on this, the bottom one's quite an interesting one actually, the curve question. I'll tell you why. I'm not going to say anything about cutting rates, actually, so to disappoint people. Sorry, Anonymous. The reason I'm going to say it is that I think it's very interesting what we've seen in the last sort of 2 or 3 months, actually. So we've seen term rates go up and then actually come down again and then move around, become rather more volatile. We published a chart in the Monetary Policy Report. We always do our staff always do decompositions. Much of that is being moved by movements in the US curve. There was a period in the middle of January when we could see a UK impact. And to be honest, I mean, at the moment, you see in the short run, I mean, it is what's coming out of Washington on tariffs that is moving that term premium around day by day and hour by hour. And I do agree with the comments that the new U.S. Treasury Secretary Scott Bessent said, which is I do think that we'd all probably like to see less volatility in that. I thought he was very wise in actually pointing to that part of the curve as the area that it would be good to see that happening. No, you shouldn't interpret careful at all like that. At all. I mean, careful was literally the point that we've got two-sided risks, and we are going to approach it in that spirit. I mean, two of my colleagues voted for 50 basis points. If you read the minutes, you will see that they agreed on one thing, which was 50 basis points, but had very different views on how they got to that conclusion. We were discussing before we started, actually, and the way the Bank of England system works. I mean, I do encourage. I get asked in Parliament quite often, can you assure me there's no groupthink in the MPC? And I say, have you looked at our voting record recently? But actually, look, I mean, I honestly, I mean, you read any of the literature on sort of deliberation and discourse. I mean, one of the things that does come out of that is that you get a better deliberation and discourse if different views are expressed and expressed openly, and I do encourage that, frankly. So, I think as long as we can explain the different views, it's not exactly a surprise that there are some different views.
Maybe while I'm at it, you are, one related difference possibly is you have much better gender balance at the Bank of England than your Euro colleagues. Any advice you can give to them? How do you pull this off, or should we
dream of
the Treasury? The Treasury gets all the credit on that one.
No, I'm not going to comment on Euro policy.
Okay, it was just about the gender mix, but nonetheless. Okay, so we have a few points on the floor. So gentleman in front, and introduce yourself. We have a gentleman in the back, and we have Lucrezia here, and that's right, Valeria as well. So these four, and introduce yourselves, please.
Kurt Geisert, I'm one of the guides in the House of European History. I had students from London in our museum 2 years ago. And I mentioned the hyperinflation in Germany in 1923, which was one of several reasons that Weimar Republic did not survive. Do you agree that the inflation we have right now in the United Kingdom, in the European Union, is relatively manageable compared to this hyperinflation?
I think that would have been too easy an answer. Okay, the gentleman in the back, please. And then we have two ladies here in the front row.
Nicholas Reinhardt at For Consulting. Thanks, Governor, for very interesting points. We discuss here the idea of a digital euro, and I know you're thinking about a digital pound. And maybe you could share a few words on that. And what I would find particularly interesting is how such an instrument might impact bank lending and the monetary transmission mechanism and the velocity of speed of circulation. Thank you.
Thank you. In front, please, front row here. Maybe Lucrezia first, then Valeria.
Thank you. Hi, I'm a journalist with Euronews. My name is Anna Butler. First of all, thank you for speaking today. My question is about President Trump. The Federal Reserve and President Trump aren't seeing eye to eye at the moment, and I wonder if you think this has implications for trust in central banks in other parts of the world. Thank you.
Thank you. And then Lucrezia in the second seat here.
So Lucrezia Reichlin, London Business School and Bruegel. I have actually two questions. The first one is, you seem to be quite happy about how inflation targeting has, cope with the challenges of these days. But don't you think that the likely situation in which central banks will find themselves is a situation in which trend inflation indeed will go down, as you said? On the other hand, volatility of inflation is on the increase because of tariffs, supply-side distortion, climate change, and so on. And so, that requires, some thought about how to deal with trade-off, facing, more high-frequency volatility and at the same time downtrend. And the second question is on the non-banks. I think this is a very important speech that you gave, and I agree that the acceleration of non-banks is a very important feature of financial markets. This has implication on central banks as liquidity backstops for the financial system, and so to also the possibility of extending the liquidity facilities to the non-bank sectors, which you have to a certain extent done. The Federal Reserve has done with the reverse repos. So this has, however, implications on the size of the balance sheet of central banks going forward, and the financial footprints and all the kind of questions that go with it.
Okay, that was quite a lot. You feel free to pick and choose: hyperinflation, digital pound, central bank credibility in the age of authoritarian governments, and then 2 important questions on volatility and liquidity.
Group them together a little bit in order. Hyperinflation. I mean, my answer is no, and I think I just want to go back to something I said earlier. I think the key thing here is that we have monetary policy regimes and we have nominal anchors, and we have to stick to them. Now, it sort of comes on to Lucretia's question, actually, first question. I think you're right, Lucretia. I mean, I think we are in a world at the moment where there are more supply shocks going on and there is more volatility and inflation. I mean, that's very clear, particularly compared to the pre-financial crisis period. And I think the question then is how well our policy regimes operate, how well we operate them, and how well we explain them, so that, as we've had to do and having to do at the moment, we can essentially explain the case for why we're prepared to look through an inflation shock, because our view is that actually the underlying trend of inflation is downwards. But I think we have to watch this very carefully, and we have to watch, obviously, inflation expectations very carefully as to how this is actually translating through. So I think it increases the need to sort of be very, very careful about how we watch that. But I do think the answer is no on the hyperinflation. On the Federal Reserve, look, I'm only going to say this, and I thought Chair Powell got it absolutely right last week. They do their job, and it sort of comes back to the point I just made. We've got regimes, we've got nominal anchors, we get on with it. And that's what we all do. I'll do Lucretia's second question, then come to CBDC. Just to say, I mean, I tried to be clear in the speech that we've introduced an emergency sort of facility for non-banks, not a standing facility, because I think it's wrong to do standing facilities for non-banks because they are not in the they're not in the part of the money system in that sense. What we do think it's sensible to do is to have the regularization, if you like, of what we do for non-banks. Because in the LDI crisis, we sort of made it up on a whiteboard in the middle of the night. A, because we don't sort of particularly want to do that too often. B, but secondly, actually much more important than that, I think it's important that we actually make it transparent. This is what is there to, this is what you can expect. But it's in our control, so we only switch it on when we think it needs to be switched on, and that will limit the balance sheet impact. The other thing to say, in the LDI crisis, of course, we actually got out of that position very quickly because our view that this is not monetary policy. I mean, one of the things that I was most sensitized to during the LDI crisis, because a lot of people reasonably said, oh, you're doing QE again. Here we go. Off you go, you're doing QE, and in an environment where, of course, obviously inflation was actually going high and going up. And I felt not only did we have to say we were not doing QE, but we had to demonstrate we were not doing QE. And the way to do that was to say, no, this is a temporary operation, and here's the proof, if you like. And I think we did that. But I think that's very important. It's also important because the other thing I'd say about the LDI crisis and problem was, look, we have to be able to intervene both for monetary policy reasons and for financial stability reasons. We can't say, sorry, can't do financial stability at the moment because it sort of doesn't sit well with monetary policy. But to do that, we have to have very well articulated regimes that people can say, yep, I understand what they're doing. So that's, again, we have to be very sensitized to that. So let me come back, come to digital currency. The key issue for me is that we get the benefit of digital technology and digital innovation in the payment system. I think that's the first question. Do we think there are benefits to be had from bringing the innovations of digital technology more into the retail payment systems? And I think the answer is yes. to that. I think it would be a failure of imagination if it wasn't. We always, I know it's maybe apocryphal, I don't know, we always quote, there was supposedly a survey done of people by Apple before the iPhone was introduced, where they said, would you want a phone that had these characteristics? And the majority said, no, I'm happy with my BlackBerry. I think they were wrong. But I think that's the starting point. Now, then the question is, and that should be the first question, the second question then is, how do we do it? If we think the answer should be yes, how do we do it? Do we create a new form of central bank money, or do we do it in the commercial bank payment systems, or do we do both? And I think that should be the next question, not the first question. And it's an open question. It's a question that we are looking at quite openly. But I am, very clear, and I've said that, the UK banks will, I think, tell you very clearly. I've said to them a number of times, look, this is a big question for the commercial bank payment systems. But let's be very clear. If you don't do it, we will do it, because actually we do think that we need to have the benefits of digital technology. But it's an open question. The first step should be, do the payment systems we've got at the moment, can they be adapted to get the benefits of this thing, digital technology, or do we need to do something else? And it's an open question.
Do we have time for one more question? Great. Any urgent questions from the floor? Otherwise, I will ask the final question. Yeah, you get to ask it, and then I'll tack on mine. Good. And introduce yourself, please.
I'm Giovanni Colicello, student. And my question is, as Mr. Zettelmeier mentioned, your tenure has been characterized by quite a few surprises, external shocks. What do you expect, or maybe can predict, that is going to be this year's positive or negative surprise?
Okay, this is a wonderful, wonderful question to end. So I'm going to tack on my question. So, a lot of my own work has been on sovereign debt and sovereign debt risks. And, one conventional wisdom in the past, certainly from an IMF perspective, is that, you don't really get runs on advanced country debt, and it has something to do with, inherent credibility of institutions, but also with the role of central banks that are somehow assumed to prevent those runs. Now, you were in a very difficult situation, and you handled it. You handled the spillovers, and so I can imagine that this is not the last time that this will occur in an advanced country, and I can think of one country in particularly, but I will not name it, so as you can be a bit freer in responding to my question, which is essentially to give advice to your central bank counterparts, and particularly on this extremely difficult issue of reconciling, the disciplining function of the market with maintaining financial stability and, of course, maintaining price stability. And so this is all a lot to reconcile in a particularly difficult moment. So how do you think about this? How can you do it?
No, it's a very fair point. The LDI crisis is interesting because the problem was actually, yes, there was obviously a big movement in UK government bond rates. The problem in the LDI sector was actually a structural problem. Perversely, I say perversely, the way pension fund accounting works, perversely may be the wrong word, but the way pension fund accounting works, actually the underlying backers of the LDI funds actually their accounting position, their solvency and accounting position was strengthened by the upshift in bond yields. So there was no solvency problem in that respect. The problem was actually much more what you might call mechanical, that the LDI funds were sub-funds of the main funds, and because the LDI funds were facing big margin calls, they had to actually call on the parent fund for assets. And actually, it couldn't be done in the time. The necessary movement couldn't be done in the time available, and there had to be a sale of assets to make it happen. And that the risk was that sale of assets set off an unstable sort of dynamic in the market, and that's why we stepped in to sort of essentially make it smooth it out and make it happen. It's actually, by the way, also why I was able to say, pretty confidently that, how long they had to complete it, because we knew what they needed to do. We actually knew very precisely what they needed to do, and we knew how long it would take them to do it. I think, to your question, I think central banks do have to be ready to sort of, in a sense, first of all, of course, we all have to have policies which we think sort of are reasonably calibrated to limit that sort of thing happening. But we will never prevent that thing happening because to do that, we would extend the world of regulation so far down the tail of risks that the cost-benefit of regulation would be, I think, just wrongly calibrated. And it is more cost-effective to use central bank intervention tools for very far-out risks down the chain. So I think the lesson of this is that you do have to be ready and able and have the tools in place to intervene in that way. I mean, great question. I wish I could predict where the shocks are going to come this year. 2 points. One, as I said earlier, we do live in a world of very much heightened uncertainty. The second one I would say, on the particular point about world trade, we published a box in our monetary policy report, which was designed to sort of tease out, some of the sort of, in a sense, the underlying mechanics of this. As I said earlier, I do have to say that fragmentation of the world economy is negative for growth. The situation for inflation in a country that faces tariffs is actually fairly ambiguous in terms of what happens, because it depends upon trade redirection, it depends upon whatever measures are taken in response, and it depends upon the reaction of exchange rates. So that's the one that you can't easily predict in advance. It can go up different ways. Thanks.
Just to say on the last point, there's a nice speech by Megan Green on your Monetary Policy Committee that makes this point, that it can go. So, Governor, thank you very much. I really wish that the next 5 years of your tenure would be quieter. Three, that they will be quieter than the first 5, but I fear not. But at least we're well prepared now. Thank you.